For most of us back in the day, it was a revelation to read the white paper and then find out that Satoshi included that famous headline in the Genesis block: Chancellor on brink of second bailout for banks. It's been 14 years and 2 months since that headline was attached to the birth of crypto. And many would argue we've lost our way in those intervening years. Crypto has, at least to some degree, become about DEXs and yield farming, PFPs, liquidity provision, collateralized debt positions, loan platforms, stablecoins, and ponzinomics. But things are often circular, and some would argue we're about to come back around to Cardano and all of crypto being among the few lifeboats offering rescue from all of the chancellors being on the brink. Ready? Let's go. Today, we're going to discuss the big $1 million bets from Balaji, the Arthur Hayes article that seems to possibly explain everything, and whether or not this is fantasy, hype, just shilling at a crazy high level, or something more meaningful for crypto, for Cardano, and for the whole global economy. If you immediately understood that this bill is labeled as a hundy, a 50, a 20, and a 10 because nobody knows what our money is going to be worth in 6 months, let alone a couple of years, or if you're finding value in these videos each weekday, please consider delegating to the Army of Spies stake pool, ticker AOS. A lot happened this weekend, and a big piece of it revolves around this idea that's been with us throughout the entire history of crypto. This is the headline that Satoshi included in the Genesis block, the first block of the Bitcoin blockchain. Chancellor on brink of second bailout for banks. This is why Bitcoin has a hard cap of 21 million and Cardano has a hard cap of 45 billion. And obviously, at least a part of why Satoshi created Bitcoin was to create an alternative to this world where modern central banks reject Austrian economics and seem to think anytime there's any kind of financial downturn, they can just print their way out of it. They can just print money to get out of any kind of financial downturn. Austrian economics, and by implication, Satoshi, think this is a bad idea. When they see headlines like this, they think we are going in the wrong direction. We're kicking the can down the road, and eventually this will come back to bite us. We'll have to face these demons that we're creating by our money printing. Obviously, a lot of people in crypto embrace this same idea, this same Austrian economics sort of perspective on the world. And a few of those people who espouse those kinds of ideals have some very strong visions of what the immediate future looks like for the US economy, global economies, global fiat currencies, a lot of big ideas. And they were expressed in very dramatic fashion just over the last couple of days. We're going to talk about those ideas. I don't think anybody knows whether they are right or wrong at this point, but I think these are ideas that are worth discussing. Here's what kicked all this off this weekend. This account, James Medlock, posted, "I'll bet anyone $1 million that the US does not enter hyperinflation," which is kind of a hilarious proposition because obviously if hyperinflation does occur, the $1 million would be worth a lot less than $1 million today. So it's kind of a good bet for James Medlock to make. Medlock probably wasn't expecting this to happen. Balaji came along and posted, "I will take that bet. You buy 1 Bitcoin, I will send 1 million USD. This is 41 odds, as 1 Bitcoin is currently worth 26,000. The term is 90 days. And then he started talking about how they needed a mutually agreed custodian who will settle the bet. He goes on to say, if someone knows how to do this smart contract, we can do it on chain. I'll just use USDC. And he posted this image, which he calls the bit signal. So this confused a lot of people because obviously, if you're in the James Medlock position, All you have to do is buy 2 Bitcoin, use one of them for the bet with Balaji, send one of them to the escrow or the smart contract or mutually agreed custodian, whatever the settlement mechanism is. You send one of the Bitcoin that you bought to the bet for the bet, and then you keep the other one. Then that way, if hyperinflation does happen and Bitcoin is worth $1 million, then you've got $1 million and you only had to send one Bitcoin, which is worth 26K to the contract. You just made almost $1 million. If Balaji is wrong and Bitcoin is not worth $1 million, then you get Balaji's $1 million. This is a no-lose bet for Medlock. It doesn't make any sense at all for Balaji. Just in case you're questioning whether that's really what Balaji meant, because his language in the first post was a little bit ambiguous, he defines it more precisely here. He says, terms of the bet. Ideally, someone can set up a smart contract where BTC is worth more than 1 million in 90 days, then I win. If it's worth less than 1 million in 90 days, then the counterparty gets the 1 million in USD. It still doesn't make sense. This is a no-lose bet for Medlock as long as he buys 2 BTC. But it turns out Balaji is not trying to make money with this bet. In fact, he knows he's going to burn, turns out, not just $1 million, but millions of dollars, because he wants to do it with Medlock and one other person sufficient to prove the point. He's just trying to prove a point here. He's not actually trying to make money on the bet. We know this isn't about the money for Balaji, that he's actually just doing this to send a message, because he put on a Twitter space with Robert Breedlove on Saturday where he explained that he's actually just willingly burning several $1 million to send out the signal to everybody that hyperinflation is not just about to commence, but is already here. He also says it in this post. The bet isn't a way to make money. It's a way to alert innocent dollar holders get to Bitcoin. And if you're curious about what kind of hyperinflation he's thinking about, he's been posting this very, very famous chart of the Weimar mark versus gold from 1914 to a period just after 1923, and of course you see the kinds of crazy hyperinflation that crypto was basically built for. So why is Balaji convinced we're going to experience this crazy level of hyperinflation? He posted, remember, the Fed did this. They caused the banks to be insolvent. They didn't tell you, the depositors, and now they're printing money to cover it. Vertically so, like a scene out of Independence Day. And he posted this chart of discount window borrowing. You can see that in 2008 and 2009, there was a gigantic spike. And then another pretty decent spike in 2020. And then we come to 2023 and we have this crazy towering level of discount window borrowing already. He also points to crazy charts like this one. So this shows the Federal Reserve's balance sheet with time on the x-axis. And you can see what they point out here. Half of the quantitative tightening done in the last year was reversed just this week. You can see this is where we were on March 8th of 2023. We were right here. And by March 15th, we were clear up here. And they're saying that that's about half of all of this quantitative tightening that was done since this date, which I think that's January 13th, 2022. Is that? Nope, that's going to be April 13th. Sorry, that's April 13th. So, I mean, that's a pretty impressive switch over the course of just a week. These might seem like little disconnected bits of data. A lot of this is summarized here, though. I'll wait to buy until after the Fed pivot. Fed undoes half a year of quantitative tightening in a single week, opens trillions more in lending at 50% above market value, opens international swap lines with global central banks on a Sunday evening. Okay, shorting now. This is a very concise summary of a bunch of different things that are happening, but how we got here and what might happen next is laid out in a huge amount of detail by Arthur Hayes in a genius article he released just a few days ago. So this is that very beautifully written article from Arthur Hayes, who we've talked about a bunch of different times on this channel. So in this article, he basically tells you, hey, we're going to talk about BTFP, the Bank Term Funding Program. And he says, suffice it to say, BTFP is yield curve control repackaged in a new, shiny, more palatable format. It is a very clever way to accomplish unlimited buying of government bonds without actually having to buy them. To fully understand why this program is so groundbreaking and ultimately destructive to savers, let's go through how we got here. We must first understand why these banks have gone bust and why the BTFP is a very elegant response to this crisis. He explains that back in March of 2020, the Fed pledged to do whatever it took to stop the financial stress brought on by COVID. So they decided to flood the system with liquidity, and we all got stimulus checks. This led to the regional banks being the most deposit rich they had ever been. It wasn't as big a deal for the big global systemically important banks like JP Morgan, Citibank, Bank of America. He says the percentage rise in deposits was noticeable, but nothing ridiculous. However, at the regional banks, all of a sudden they had more deposits than they had ever had before, and they had to do something with that money. And what they did with that money was buy long-term US treasuries. So normally this would be a pretty normal thing. But as Arthur Hayes puts it, we were at sort of like 5,000-year lows in interest rates. Interest rates had been nothing for forever. Interest rates were at 5,000-year lows. The problem is any small increase in the general level of interest rates would lead to massive mark-to-market losses on banks' bond portfolios. So they buy these long-term US treasuries back during COVID when interest rates are extremely low. But what has the Fed been doing since then? The Fed has been hiking interest rates, which means the value of those long-term US treasuries went down. Now, if those US treasuries were marked to market, those banks would have experienced giant losses, which is why they haven't been talking about the actual market value of those securities. It's been showing up in little tiny footnotes, like with SVB. There was one guy who noticed a little tiny footnote in Silicon Valley Bank's 10K. He noticed it last month and published a few posts on social media about it. Nobody else noticed or seemed to notice that all of the regional banks had this gigantic unrealized loss on investment securities that you can see here. All of those long-term treasuries were now worth much, much, much less than when they bought them. However, they were just holding them. They hadn't sold them, so they were unrealized losses. This becomes a problem when you start seeing bank runs like was experienced by Silicon Valley Bank, because the treasury securities they're holding, if they have to sell them to satisfy the depositors coming in on the bank runs, they're not going to be worth enough to cover the deposits. That's what's really been happening with these banks. These banks took all those deposits they got during COVID, they went out and bought long-term US securities. But then when the Fed started hiking rates like crazy to try to control inflation, the value of those long-term US Treasury securities went way down, and all of a sudden they didn't have assets to cover all the deposits. And the problem is being pointed out by Arthur Hayes and Balaji and a lot of different people is that it's not just a handful of the regional banks, it's all of the regional banks. All of the regional banks seem to be deeply upside down in these US treasuries. All of them seem to be insolvent. Of course, there are some, he points out there are some that made some wise decisions to kind of hedge against this result, but a lot of them didn't. He said, Of course, the banks could have hedged their interest rate exposure by trading interest rate swaps. Some did, many did not. You can read about some truly stupid decisions made by SVB's management with regard to their hedging and the massive interest rate risk embedded in their government bond portfolio. So some of the banks hedged this risk, some of them did not. Apparently, SVB was on the did not list. And now we find ourselves in this position where all of the banks seem to be insolvent. Some great number of banks, there are articles circulating right now saying there are hundreds of regional banks that are in basically the same position as Silicon Valley Bank. So what do the feds do? They know there's this gigantic problem. There's a gigantic number of banks that could end up in exactly the same position as Silicon Valley Bank. What do? They go with this BTFP program. So Arthur Hayes is going to break down exactly what that program is here. And I think a lot of people don't actually understand what's happening here. So he's going to take the actual language from the release, from the federal release, explaining exactly what the Bank Term Funding Program is, and then put it into the vernacular. He's going to put it into words that everybody can explain. So the first section here, you just need to be a U.S. bank to partake in this program. The next section, the financial instruments eligible for use as collateral under the program are largely U.S. Treasury debt and mortgage-backed securities. They set a cutoff date. These have to be things the bank owned as of March 12th. So they can't go out and collect more going forward. This would create kind of like a perpetual infinite money glitch with these banks. We don't want that to happen. So they set this cutoff date of March 12th, and it has to be U.S. Treasury debt or a mortgage-backed security. There are no size limitations. If your bank holds 100 billion of U.S. Treasuries and mortgage-backed securities, you can submit that total amount to be funded using the BTFP. This means that the feds could, in theory, lend against the entire stock of U.S. Treasuries and MBS securities held on U.S. banking balance sheets. That's an amount equal to $4.4 trillion. We're talking this program, this BTFP program, could potentially lend the banks $4.4 trillion. So now he's going to talk about quantitative easing. He says quantitative easing is a process whereby the federal credit banks with reserves, and in return, whereby the Fed credits banks with reserves, and in return, banks sell the Fed their U.S. Treasuries and mortgage-backed securities holdings. We're familiar with quantitative easing because that's basically what the Fed has done. That's basically what the Fed has done for most of the financial crises in a lot of people's lifetimes lately. Under the BTFP, instead of buying the bonds directly from the banks, so under quantitative easing, they would just buy these U.S. Treasury securities and these mortgage-backed securities from the banks and credit them with reserves. Instead, under BTFP, they're not going to buy the bonds directly from the banks. The Fed will print money and lend it to the banks with those U.S. Treasuries and mortgage-backed securities as collateral. So now it's just a loan. They don't have to call it quantitative easing because it's a loan. It's not a purchase. If depositors wanted $4.4 trillion in cash, the banks would just pledge their entire U.S. Treasuries and mortgage-backed securities portfolios to the Fed in return for cash, which it then passes to depositors. Whether it's QE or BTFP, the amount of money created by the Fed and put into circulation grows. Here's the important part. The collateral valuation will be par value. Margin will be 100% of par. So they're not even going to lend to them at the current market rate of those U.S. Treasuries and mortgage-backed securities, not their actual value in the market today. They're going to give them the full value that the bank paid originally for those securities. So the banks aren't going to lose any money. They get this loan at the full value. They say program duration, March 11, 2024. The program is stated to only last 1 year. Arthur Hayes says, when has a government ever given back the power that the people gave them during a time of crisis? This program will almost certainly be extended preemptively Otherwise, the market will throw a big enough fit to demonstrate it needs its fix of printed money, and the program will be extended regardless. So he's saying here, hey, this is a loan, but this is a government in a time of crisis we're talking about here. What's actually going to happen? This March 11th date of next year, 2024, is going to come, and they're pretty much just going to have to extend the loan. They're going to sell this to us like, hey, don't worry, the banks are going to pay this back in a year. But when that year comes, they're not going to make the banks pay it back. They're going to extend the loans. The question is, for how long will that loan get extended? He said this is actually bigger than COVID quantitative easing. The Fed printed 4.189 trillion in response to COVID. So that's over the entire course of COVID. Right off the bat, in this case, the Fed implicitly printed 4.4 trillion with the implementation of BTFP. He actually thinks this is the path to QE infinity. He says, sure, the BTFP document points out this is all supposed to end 1 year from now. But as I alluded to above, I don't believe this program will ever be ended. And he thinks they'll actually loosen the eligible collateral rules to basically any government bond that these banks are holding. He says he also thinks that the Fed will either cut rates at the March meeting or a nasty recession will force them to change track a few months from now. He says that a year from now, the Fed is definitely going to extend this program because if the Fed doesn't extend the life of the program and expand the notional of eligible bonds, and the same sort of bank runs we're seeing now are likely to happen again. Given the Fed has no stomach for the free market in which banks fail to do due to poor management decisions, the Fed can never remove their deposit guarantee. Long live BTFP. I'm sure that is abhorrent to all you Ayn Rand wannabes. The continuation of BTFP solves a very serious problem for the U.S. government. The U.S. Treasury has a lot of bonds to sell, and he believes that the BTFP will be expanded such that any eligible security that a bank has can be basically bought or loaned against. This gives the banks comfort that as their deposit base grows, they can always buy government debt in a risk-free fashion. The banks will never again have to worry about what happens if interest rates rise and their bonds lose value and the depositors want back their money. The Treasury can easily fund larger and larger U.S. government deficits. This allows the U.S. government to run the same growth playbook that worked wonders for China, Japan, Taiwan, and South Korea. While everyone might cheer yay growth, in reality, the entire public is paying a stealth inflation tax at the rate of nominal GDP minus government bond yield. This solves an optics problem, right? Because these are just loans. People aren't going to understand. The general public is not going to dig into how BTFP works. They're just going to be happy the problem is solved, and everybody can say, but don't worry, there's no quantitative easing. His advice to everyone is get out. He says assets like gold, real estate, and obviously Bitcoin. He's obviously a Bitcoin guy. Whenever someone writes like he does about Bitcoin, I find it acceptable just to substitute the word crypto there. But he says gold, real estate, and Bitcoin are not liabilities on someone else's balance sheet. If the banking system goes bust, those assets still have value, but they must be purchased in physical form. You are not escaping the insidious wrath of inflation by purchasing an ETF that tracks those assets. All you're doing is investing in a liability of some member of the system. You own a claim, but if you try to cash it in, you will get back fiat. And all you have done is pay fees to another fiduciary. This is the type of role he describes elsewhere in this essay, I believe, as a fee donkey. He does not want you to be a fee donkey. But he does say what he thinks is going to happen next for crypto. This section is called To the Moon. He says the end game is here. Yield curve control is here. BTFP ushers in infinite money printing globally. He thinks all the other central banks will have to follow suit. The ensuing Bitcoin rally will be one of the most hated ever. How can Bitcoin and the crypto markets in general rally sharply after all the bad things that happened in 2022? The media is likely to push the narrative that this banking crisis happened because banks accepted fiat deposits from crypto folks. He thinks that's farcical. I agree with him. He says he is largely done with stonks. He says, if there is a short-term trading opportunity where I think I can earn some quick ducats and take my profit and turn it into Bitcoin, he'll do it. Otherwise, he's liquidating most of his stock portfolio and moving it into crypto. So obviously, we have some people who have embraced this kind of thesis, Balaji and Arthur Hayes being the two most notable examples right now. And they really believe we're going to face, Balaji sort of characterizes it as, this crazy hyperinflation, the kinds we've seen in places like Zimbabwe and Venezuela and, the Weimar Republic. Arthur Hayes seems to more mildly label it as, infinite money printing, this being the equivalent of infinite QE. But if either of those two characterizations are at all accurate, you can imagine this sort of being the fruition of kind of the crypto embrace of Austrian economics, that when you engage in this kind of central bank modern behavior where you just, quantitatively ease your way out of every single financial downturn, when you print money every time you encounter a financial downturn, you're sort of just kicking the can down the road until you get to this point right now when it becomes, okay, we can no longer just print and then go back to business as usual. Now we have to print forever. We get to the infinite money printing, as Arthur Hayes calls it. Balaji has a slightly more extreme version, thinking it leads to the kinds of crazy hyperinflation that he details, from history. But in either case, it's not, it's kind of the thing we've always talked about, that the central banks would just print too much. And when faced with an asset like a Bitcoin with a cap of 21 million, like a Cardano with a cap of 45 billion, the value of those assets, this has kind of been a big part of the whole crypto thesis all along. I guess we're going to find out. I was thinking this would be something we would find out about over maybe the next decade. But if these guys are right, maybe this is something we find out about over the next 24 months, the next 48 months. I'm looking forward to seeing what happens. I hope you had a great weekend, and I'll talk to you tomorrow.